Diversification is the best protection from losing your hard-earned wealth, but too many investors are getting this wrong. After this episode, you won't be anymore. Welcome to Get Started Investing, a show that helps you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are talking all things diversification. We're going to cover what it means, how too many investors get it wrong, what good diversification looks like, and how you can check your own diversification. But all of that is just an entree to the main course where I reveal my full portfolio and do a diversification check live on air. Well, I mean, we've already done it, but we'll reveal it live on air to talk about how anyone can check their own diversification using AI.
Oh, wow. Well, this has all been inspired by a question from Get Started Investing community member, Chris.
Hey guys, I've been religiously dollar cost averaging into a S&P 500 ETF for a while now, IVV. I'm at a point where I feel like I might need to diversify further. I know the ETF is diversified within the US, but I'm thinking I could diversify into a different sector, geographically, or maybe something just more aggressive. My question is really, how do you know when to diversify your portfolio further? What's the process and how would you go about this? I'd love to hear your thoughts.
Love that question, Chris. And remember, if you want to ask a question, there's a link in the YouTube description or the podcast show notes to record your question and get it played on the show. But Bryce, before we get into unpacking all things diversification, we should say a massive thank you to our long-term sponsor here on Get Started Investing, Betashares Direct.
That's right, Ren. And let's be honest, there are members of the Get Started Investing community, including myself, that are at points in time think they're pretty good at reading the market.
Oh, yeah? How's that going for you?
Let's just say not great.
Okay, well, look, the truth is we're naturally overconfident as humans. And when it comes to investing, that can lead to some pretty poor decisions. But the good news is there is a smarter way. You can follow strategies built by professional investors and invest in them at a low cost.
Love that. Well, with Betashares Direct, you can access 10 diversified managed portfolios built by their expert investment team using ASX traded ETFs.
These portfolios are designed to help build discipline, diversify your portfolio, and take the emotion out of investing.
And every time that Betashares rebalances the portfolio for you, there's zero brokerage. That means no wealth leakage from fees every time they make a move.
There's a flavor for everyone, from core multi-asset portfolios to more focused options like the passive income portfolio, which aims to deliver regular monthly cash flow.
There are 10 managed portfolios to choose from, so head to betashares.com.au/direct to find out what suits you.
Betashares Capital Limited is the issuer of Betashares Direct. Read the PDS and TMD at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for more info on fees and costs.
So Ren, this episode is all about diversification. So let's start by defining what we actually mean by the word diversification.
One of the most used words in investing,
Big
you'd have to
time.
say.
Make sure you're diversified.
So here's like the dictionary definition, the investing dictionary definition. Diversification is the strategy of investing in a wide variety of assets with different characteristics to reduce risk of losing money in a portfolio. So what do we mean by that? Like the classic example, which a lot of Australians, well, at least older Australians would have, is owning both stocks and property. And so if the stock market crashes, you don't lose the money you invested in property, or if the property market crashes, if it ever crashes, in theory, you wouldn't lose the money invested in shares.
That's right.
That's the diversification example 101.
Yeah, it's the whole don't put all your eggs in one basket.
Yeah, pretty simple.
Yeah, now there are different ways that you can be diversified. In the definition there, Ren, you spoke about across a variety of different assets, and that's where you can start. You can diversify across different assets. Think stocks, think bonds, think property, gold, cryptocurrency, assets that ideally are not correlated to each other. You can diversify across regions, think Australia, US, Europe, obviously anywhere around the world. And then you can drill down, you can look at industries, for example, diversify across things like banking, mining industry, tech, retail, you name it. So there are plenty of different ways that you can cut this up and think about diversification.
Okay, pretty simple so far. Nothing we've said that is groundbreaking, but here's where we think a lot of investors get it wrong. Too many investors become collectors and think they're diversified when they're not really. Because diversification isn't about the sheer number of things you own. If Bryce owns 30 stocks and I own 20 stocks, he's not naturally more diversified than I am. What we see is a lot of investors owning things that are exposed to the same source of risk. If you own shares in Apple and then an S&P 500 ETF and maybe a large cap global fund manager that mainly invests in the US, you're not diversified. You own 3 things that are all exposed to the US stock market collapsing.
Yeah, that was me of most recent times. Definitely overweight US. So why then, Ren, is, I guess, diversification not about the sheer number of things? Like if it's not just about going out and getting 40 different stocks.
Yeah, it's all about the risks you're exposed to. That's the name of the game with diversification. That's where people are looking at the wrong metric. It's not about how many different things you own. It's about what risks each of those things are exposed to. And the name of the game with diversification is you don't want one risk to materialize and blow up your portfolio.
Yeah. So using the above example, we have Apple, S&P 500 and large cap active. A share market crash would blow them all up, or a US recession as well, because they are all stocks. They're all listed on the stock. They're all access to the equity market or the same asset class
in the US.
In the US.
Yeah. Or like a common example for all Australians is owning Australian property, owning mostly Australian shares, and then also their job isn't in Australia and they get paid in Australian dollars. An Australian recession blows all of that up.
Yeah.
So that's why it's important to be globally diversified, because then you're not purely reliant on the Australian economy doing well.
Yeah.
So if that's how people get it wrong, they become collectors and they start counting the number of different things they own rather than thinking about what sources of risks they're exposed to. What does good diversification look like? And to Chris's question, how do you know when you're diversified enough or when you need to diversify further?
Well, you need to think about the risks that you're exposed to and then what would happen. So good diversification is when one risk doesn't impact all of your investments negatively. So using the example that you just spoke about, Ren, if you have all of your money invested in Australia across different asset classes, the risk you're exposed to there is Australia going through an economic recession and dragging everything down. If you don't have any exposure to any other geographies, then you can probably look at that and say, you know what, I'm actually not that well diversified.
And good, okay diversification is making sure no one risk materializing blows up your portfolio. Good diversification, I would say, is actually when one of those, the assets or the things that you own actually does well when one of those risks materialize. So there's always something to like counterbalance the fall. And like, let's use some examples to bring that to life. So an Australian recession, let's use that as an example.
Yeah.
That's bad for Australian shares.
Yeah.
It's bad for Australian property. It doesn't affect global shares. So that's okay
No one cares
diversification.
about Australia.
Doesn't affect gold.
No.
Doesn't affect crypto. So they're good assets to have. But also, like, the question is, what would it be good for? Maybe Australian bonds. Maybe you see when a recession happens, you see interest rate cuts and then bonds do better. So maybe that's an asset class that actually is the counterbalance in that example.
Well, let's look at something that's playing out right now, which is the US-China trade war. Obviously bad for US shares, Asian shares, and Australian shares, as we're a major trading partner for China. What it doesn't affect is Australian property. You could argue that on the margins, if Chinese buyers are hurting a little bit, we might be impacted a little bit, but that's certainly on the margins. What it's good for, you could argue, is gold, as investors sort of flee to safety, as they say, and look for assets that are not directly related to US and Australian and Asian stocks. Okay,
so they're two pretty vanilla examples of diversification and how it would affect different asset classes. Let's get a little bit more out there. Let's think about some wild risks that could materialize. Australia's biggest company, Commonwealth Bank, goes bankrupt.
Wow.
How do we diversify?
Meltdown.
How do we diversify ourselves away there?
So it's bad for Aussie shares, Aussie property, and Australian bonds.
Yeah, it's bad for basically everything else.
Yeah, we're cooked. We're absolutely cooked. Won't affect global shares, gold, crypto.
Yeah, so that's good. Like that's okay diversification. Then you're diversified if you've got global shares, if you've got other assets.
Yeah.
Yeah.
You could argue it'll be good for other bank shares. But investors might also say, shit, if Australia's biggest bank goes bankrupt, it might not be looking good for some of the other bank shares as well. So it could go either way.
It depends what leads to the bankruptcy. If it's something that affects the other bank shares, then it wouldn't be good.
It could go either way.
But if it's something that's just about Commonwealth Bank, then maybe there's a heap of market share to be won.
Yeah.
So I think, look, there's some examples, but hopefully they try and illustrate the point that what good diversification looks like is thinking about the risks that could affect your portfolio, how likely they are to materialize, and how bad it would be if they do materialize, and then making sure that the biggest risks to your portfolio won't affect all of your investments in the same way.
Yeah. I just want to note here as well that if people are sitting here listening and thinking, well, I don't have access to gold and crypto and Australian property and all that sort of stuff, the great news is that you can get access to all of these asset classes through the stock market. Well,
and the even better news is you can get the access to all of them at $0 brokerage with Betashares Direct.
Perfect. Love that.
Well, that seems like a good point to take a break and thank our long-term sponsor here at Get Started Investing, which is Betashares Direct.
Betashares Direct offer access to all ASX-traded ETFs and managed portfolios, making it easy to build a diversified investment strategy.
That's right, Bryce. Diversification is the name of the game. That's what we're talking about in this episode. And their 10 managed portfolios have inbuilt diversification. Their team of professional investors sit down and design portfolios to be diversified, to be able to manage all different types of risks, all different types of markets, and to grow wealth over the long term.
So head to betashares.com.au/direct to find out which of the 10 managed portfolios suit you.
Diversification is known as the only free lunch in investing. So I put my portfolio through an AI tool to see how diversified I was. Am I eating or am I going hungry? Let's find out.
I cannot wait to find out, Ren. So how do we check our own diversification beyond just using an AI tool?
Yeah.
And I think there are some major... there are a few things to think about. Firstly, it's all about the risk. So how much do your investments overlap in terms of the risk that they're exposed to? So we've spoken about, are they all exposed to the US? Are they all exposed to Australia? Secondly, how likely is that to materialize, or how likely are those risks to materialize? And then thirdly, how negative would it be if they actually did materialize? Like, what impact is it going to have on your portfolio? And I think about a lot of people that might have just experienced this for the first time, the market pullback that we just saw, and everyone being heavy US tech, a really good opportunity to reflect on that and think about the exposure that you may have had, and think about diversifying globally.
So Bryce, as I said, I put my portfolio through AI. I just asked ChatGPT to give me an assessment of how diversified my portfolio was. Now, for the purposes of this exercise, I didn't include my core portfolio because I know that is well globally diversified. So currently I own 22 stocks. So just so people know, just very quickly, just names, no weightings. In Australia, in alphabetical order, BHP, Botanics Pharmaceuticals, Catapult, Cochlear, Guzman y Gomez, HitIQ, Mass Group, Mineral Resources, Macquarie Group, ResMed, WiseTech Global. And then in the US, Axon Enterprise, Coinbase, Deere, Alphabet, Jumia Technologies, Eli Lilly, Novo Nordisk, C Limited, Shopify, Supermicro, Spotify Technologies.
Nice.
Okay, I know that was quick.
Response?
Yeah, but we'll unpack them in more detail because all I did was ask ChatGPT, gave them the names and said, assess how diversified this portfolio is. And it was pretty comprehensive, the response. So...
You sound surprised.
Well, yeah, I was surprised.
ChatGPT is awesome.
Yeah, I guess I just never thought of it in this use case before. So it had 6 different categories in which it assessed my diversification. So the first one was count and concentration. And it said, I hold 22 stocks, which is a healthy number for reducing individual company risk. But diversification isn't just about how many you hold, it's about where you're invested.
Perfect. Aligned
That's
with
good.
what we said.
Exactly. So number 2 was geographic exposure. And ChatGPT gave me a tick and said decent global reach, but heavily tilted towards Australia, 11 out of 22 stocks, which may expose you to domestic, economic, or political risks. It told me to consider more non-Australian exposure if I want geographic balance.
Nice. Also good.
I guess that aligns with what we...
Which makes sense. Over half your portfolio, exactly.
Yeah. All right. What about this?
What about sectors?
Sector exposure. So it separated all my holdings into sectors. Technology being the biggest sector with 7 of the 22. Healthcare next with 5 of the 22. And so it gave me a tick. It said, well diversified across sectors, though tech and healthcare dominate at over half the portfolio, and minimal exposure to utilities, energy outside of mining, or traditional consumer staples.
Nice. So all those 3 we spoke about, count and concentration, geographic, and sector exposure. Are there any different ways that it's cut it up?
Yeah, so the next one was market cap and growth stage, which is something we haven't really spoken about, but it gave me a tick. Good spread across growth stages, which gives you both stability and upside potential. Thematic exposure was the next one.
Nice. Yeah.
I got a tick there as well. I'm liking the amount of ticks I'm getting. Strong thematic tilt towards future-facing industries, but a warning, some overlap in themes, e.g. tech and healthcare heavy, may amplify volatility during market rotations. Certainly what I'm feeling at the moment.
Yeah. Anything else?
Well, then the final category was a category on suggestions to improve diversification. So here's what ChatGPT suggested. Consider adding traditional consumer staples like Woolworths or Unilever, utilities or infrastructure like APA Group and Transurban. It also suggested consider adding ETFs or LICs for sector or country balance. And then finally, energy transition exposure like lithium, renewables, or nuclear.
I'm going to say that there's something in this analysis that ChatGPT, I think, has missed completely, which is assessing it in the broader context of assets classes that are available.
That's fair. Yeah.
So it hasn't kind of gone, here's what I suggest, but you're also missing gold,
infrastructure,
crypto,
property.
And it's like you're overall still very long equities.
Yeah. Well, ChatGPT is still learning. But look, the final verdict, according to ChatGPT, is I'm 80% of the way there. My portfolio is sector diverse, balanced across growth stages, and forward-looking in themes. But it is overweight Australia and underweight staples and defensive. And I have high exposure to volatile and growth-heavy sectors. So I think... it doesn't know everything, but ChatGPT can certainly be a good resource to just put your own portfolio in and see what it thinks. Because diversification, as we said earlier in this episode, is something that a lot of investors, at least in our opinion, are getting wrong.
Absolutely. Well, Chris, thank you so much for the question. We love hearing from you. There'll be a link in the show notes or the description below for you to leave a voice message just like Chris did. Or you can head to equitymates.com/contact if you would like to write to us. A reminder as well that we have all of the Get Started Investing episodes now available on its own YouTube channel, Get Started Investing. So if you want to watch all of the content, if you're listening to us at the moment on a podcast, make sure you head over there. There'll also be a link in the show notes. As always, Ren, though, great to chat stocks. I might throw mine through the old ChatGPT as well to see how diversified I am. But until then, we'll pick it up next episode.
Sounds good.